Hello again, everyone. This is Ken Weber, president of Weber Asset Management. I'm here once again in New York, and once again out in Reno is my friend and partner, Jack Bowers, our chief investment strategist. Today is March 28th, Thursday, and the market has mostly recovered from the downturn that it hit in March. I'm getting my months mixed up. I apologize. It bottomed out, and we spoke to you shortly after the bottom, and we said it was down around 30%, and we said we think it might go down a little bit more. But Jack and I both agreed that we were pretty near the bottom. Knock on wood, that turned out to be true, although we don't know what the future will bring. So Jack, I want to talk to you about the various points of the big disconnect that people are asking us about. The economy is going into the toilet. People applying for unemployment in record numbers. Companies and small businesses are either closing down permanently or semi-permanently or temporarily. So the headlines are bad, and yet the stock market is, as I said, making up most of its lost ground, and people are just not getting the disconnect between the economy and the stock market. So Jack, I'm going to ask you to explain what you see as the reason for why that is the case.
Yes. I think some of it is skewed perceptions. And some of it is just the current mix of the stock market from an industry standpoint. So, and I'll try to cover those in 4 points. First of all, I think the mortality risk of the virus itself is considered to be greater than it really is for a small group of the population who is really hunkered down right now. And I saw a chart the other day that showed that for most people over the age of 25, that the risk of coming down with a virus mortality-wise is pretty much equivalent to just aging 12 months. So that's bullish for the economy because I think a lot of people think it's a lot worse than that right now. And so some portion of the population that's really heavily locked down, I think, as their friends and relatives go back to doing normal things with social distancing guidelines, they're likely to join up with that and become a little less fearful. So I think that will help the economy get back on track quicker than maybe a lot of people think it will at this point. Moving on to the economy, when you look at the unemployment numbers, it looks really ugly, like the Depression or even worse. But I think what is important to appreciate there is that 80% or so of the job losses are really job furloughs. And it's likely that almost all of those will go back to their current employer as things open up. The government benefits are paying people more to stay at home than to work until the end of July. So I think we may not see a full return until August. But I think that people will be surprised that those unemployment numbers come down as fast as they went up as the year progresses. I know there is a lot of concern about a second wave of infections, and I think to some degree it's valid. But here in the US, locking down for the first wave was not particularly effective. So I don't think we're going to see it as being as big a problem as it was before. You have a situation in China where they're actually seeing a second wave, and they're handling it quite a bit different. Once you have additional testing capacity, you can really focus on quarantining the sick rather than trying to do a relatively ineffective quarantine of the healthy. And China is doing that now in the city of Wuhan. They tested 8 or 9 million people when they saw this second wave. They found 180 people that tested positive, which is a very small percentage, and they quarantined them. And they really didn't have to lock down that much this time around. I think they closed the gyms and the bars, and those will probably be open pretty quickly. So I think here in the US, we can mimic that. If we have a second wave, just step up the testing, focus on trying to find the people who are sick and quarantine them rather than trying to lock down the economy, which really didn't work that well anyway. So that's bullish. It means, I think, what we're seeing in terms of a rebound in economic growth is probably going to continue uninterrupted pretty much for the balance of the year. And then focusing on 2021, I know the general population has very low expectations for a vaccine, but I've been very impressed with the mRNA technology that a couple of players are using. And I think that particular technology allows you to get to market very quickly with a safe, effective vaccine. And I think people will be surprised how well this works in 2021. For when those who are willing get these modern vaccines and go about their business, I think it'll kind of pull a lot of people who are normally skeptical about vaccines.
Right, as I mentioned to you when we were chatting before, I saw a poll just today about 49% of the population is willing to take an approved COVID-19 vaccine, which I thought was astonishing because I know you said you wanted to sign up to be a volunteer. I don't want to.
Yeah, I tried to get to be part of one of the trials because I love this mRNA technology. It's proven safe already and very effective.
I'm not ready to be a volunteer, but certainly when the FDA gives its stamp of approval, I'm on board with the vaccine. We know the flu vaccine, the seasonal flu vaccine, is only 20 or 30 or 50% effective depending on the year. But
right, because of a different type of virus.
Different type of virus, but once it's approved, I certainly am going to tell everybody I know this is our best shot at staying safe. And so certainly I'm in the higher risk group. I'm a bit older than you, Jack. So I certainly would get a vaccine as soon as possible. And, I was surprised to hear you say that people are skeptical. I think if we can get it by the end of this year, or at least get the phase 3 testing, where it's into the big scale testing, I think that would be a real stock market mover to get people out into the economy.
Yeah, it already is. Some of the early trial results came out last week, and it's actually sparked a growth to value rotation. And I think that's because the smart money gets how important a vaccine is and how well it's going to work. And even if the population remains skeptical, it still is real. I don't think just a lot of people think vaccines take forever and they're not safe and they're not effective. And mRNA is different, and it may turn out to be the fastest to market, the safest, and the most effective vaccines
and
I've ever seen.
Well, I certainly hope you're right. Of course, the issue is what happens to people 6 months after they take the shot, 10 months, 12 months, 2 years. So
right. They've got trials to address that, and everything is looking good so far. So I'd be surprised. A lot of people who are doubters are saying, "Oh, you'll have to show me, on this vaccine thing." And it's like, no, the vaccine progress is real. It's really a case of show me that this isn't going to work by 2021.
Right.
And there's a lot of installed capacity for this as well. It will not be hard, based on investments that are being made right now, for billions of doses to be available in 2021. So I think it's safe to say, the medical workers may all be inoculated by the end of this year, and anybody who wants the vaccine may be able to have it in 2021. So yeah, that's economically bullish as well.
Let's move on to some of the other factors that are propping the market up. Again, we discussed earlier about the role of the Federal Reserve. Jay Powell and his team at the Fed have really opened the spigot in an unprecedented way, pumping $1 trillion, then another $1 trillion, then another $1 trillion into the economy. And so certainly that has kept the market afloat because bonds are not paying a lot of interest. It's a matter of where is the money going to go. And so when people around the world literally look at what am I going to do with my money, they see Europe and Asia not looking that great, pretty shaky right now. And so the money is pouring into the US stock market. And I think that is one of the key factors that is certainly propping up the US stock market. The question is, how long will that last? So Jack, you want to talk about that for a moment?
Mm-hmm. Yeah, I think as Powell has said many times, the main goal there is to prevent avoidable bankruptcy. Another way of saying is keep a big credit crunch from making things worse. And the Fed has been very timely and very effective, and they had all the tools from the financial crisis plus a few new ones that they came up with, and I think it has done the trick. There are some businesses that were going to go bankrupt anyway in the next 5 years, so many of those will happen this year. But to a large degree, the Fed has provided a lifeline that will see us through this whole thing, and I think it's allowed the stock market to price stocks based on 2021 or 2022 earnings. And that's one of the reasons we've seen this rebound. The other reason is that a large portion of the S&P 500 capitalization is more related to the digital or gig economy companies than to the brick and mortar companies. I would guess right now maybe 75 to 80% of the S&P's makeup is digital gig. Maybe 20, 25 is brick and mortar. I went through the other day and added up the total market cap of sum total of energy companies, airlines, hotel, leisure, restaurants, and it came out to this incredibly low number. It's like 5% of market cap. So that kind of shows you,
Incredible.
how different the stock market is from the real economy. And if, a lot of people appreciate that with the NASDAQ index because it has always been viewed as kind of a digital economy bellwether. But what we have right now with the S&P 500, it looks a lot like the NASDAQ did in the late 80s, and it's progressively becoming more and more a digital economy play.
Another thing you and I discussed earlier was the fact that the Great Recession of 2008, 2009 taught us many lessons. So that's one of the reasons the Fed is pumping money in. And the other thing is that the banks, the bedrock of our economic system, are much stronger and safer than they were back during the Great Recession. So that, I think, also helps consumers and helps investors have more confidence in putting money into the U.S. economy via the stock market.
Yes, I think there's a lot of people who don't believe the banks are any stronger, but they really are. And so even though those stocks for the banks got pounded pretty good, they're also sharply rising now. Now that people are, as the economic uncertainty is diminishing, people are becoming more confident in the cyclicals in general. So you see all the stocks that were, pounded down are now the biggest movers on the recovery side.
Right. As some of our clients know, both now and a few months ago, you were a little more optimistic than I was. I'm still a little pessimistic about the next 6 months in terms of what happens if there is a second wave of COVID coming in. I hope I'm wrong. I hope those treatments, both a vaccine and an actual treatment for the disease, come along. And so once that happens, my pessimism will dissipate. And so I will join your optimistic camp a little bit more. I'm definitely long-term optimistic, but I'm just a little worried about the next 4, 5, 6 months, a little bit more than you are. So I hope I'm wrong. I hope you are right. We just have
I don't see us revisiting the lockdowns because they didn't work that well the first time. Whereas the social distancing guidelines, for the people that follow them, they've worked very well. And I think it's really a focus on that going forward. I don't see us. We may do some things like China has had to do some things, but I don't think we're going to try to ruin the economy.
Whether lockdowns work or not, I mean, I happen to think they do work, but the masks are the key thing. The social distancing is the key thing. I mentioned that I was in Manhattan yesterday. I saw about 70% of people were walking around with masks.
Yeah.
I hope that's true for all highly populated areas, all cities, because that's.
It's been true in Nevada. And what's also interesting is before, the grocery store experience was just miserable. It was crowded with long lines and a lot of people in there. Parking lots were all full. And then as soon as Nevada unlocked last week, it's like there's absolutely no one in the supermarkets. It's become very pleasant again. The supermarkets are really the only place I've been going the whole time. So you kind of have to wonder, once you stop this essential versus non-essential business thing, you're actually giving people more space to spread out in the stores. So if anything, the transmission within the shopping experience is actually down now because there's more places for people to go.
And hopefully the hoarders who are stocking up for 5 years worth of toilet paper have gotten their fill, and they can let the rest of us normal people go in and shop.
Right. Yeah. I think they need to market price toilet paper to rein the hoarders in. But the anti-gouging laws are preventing that from happening right now. So we're kind of living the USSR experience.
Right. We only have a few minutes left, Jack. I do want to touch on the bond market. You have done a very good job for our clients. Again, past performance, we cannot guarantee the future, but our bond funds have done quite well. Thank you for picking the good bond funds at the moment. Talk to us about, fixed income. People living off of fixed income are really hurting right now because interest rates are so low. But I know you have some thoughts about the bond market and bonds and how difficult it is to pick and choose right now among the various choices.
Yes, I think government bond yields are low, and they will probably be rising over time, but which is negative for government bonds going forward. But we are still in a very low inflation era, and if anything, it's going to stay that way for a long time. I think some people think the Fed will be at this 0 point again for at least as long as they were after the financial crisis, and that would not surprise me. The more that businesses and individuals rely on the gig economy, the less inflation there is, because you can pretty much produce as much of the gig economy as you want with very little investment. So I think the best way to focus right now on bonds is in the corporate bond universe, where earlier on there was big credit risk concerns. But we're now at a point where the credit risk is diminishing as uncertainty with the economy declines. So the high yield bonds are doing well, even the regular corporate bonds are doing well as this credit risk factor diminishes. And we continue to have in many of our portfolios a lot of high yield bond exposure. I think high yield bonds will do really well over the next 12 months, even though they got hit rather hard during the sell-off.
But we do have positions in investment grade bond as well.
Yes, it's at least I think 40% corporate bonds, and again, interest rates can rise a little bit, and the corporate bonds won't get hurt a whole lot because the credit risk will be coming down at the same time. To some degree, the corporate bonds are acting like high yield bonds, which is one of the reasons I like the high yield sector right now. The companies have already been downgraded, don't really have that much risk of further downgrades, whereas the people that are the highly rated credit, like you have in the muni universe, is at big risk of downgrades.
I know you're not a fan of the munis currently.
Well, they are rebounding like the high yield bond market, because essentially all munis are like high yield debt to some degree at this point. And I think that's, they could continue to do well if the high yield bond market continues to do well. It's just that's not what people who buy munis expect. They don't expect to be in a high yield bond. And I think as some realize they are, there's a chance of continued outflows. And so that's the main reason we downgraded them in the newsletter last month. Performance wise, if you're comfortable with owning a high yield bond, you can stay in munis and you may end up doing well.
Right. As we've discussed in the past, we don't generally embrace muni bonds, but sometimes clients will.
No, I generally, the opportunities on the taxable side, even net of taxes are generally better than what you see with municipal yields. So I kind of see municipal bonds as something for people who don't like paying taxes more than people who are investing for
right.
the best after-tax return.
Right. So as opposed to looking at the bottom line, it's more of what they feel. They want to not pay taxes.
Yeah, it's a matter of priorities. Some people want to grow their portfolio the fastest they can after taxes. Other people want to avoid taxes.
Right.
And for that group, almost all of them are going to discover munis at some point.
Right. Right. All right, Jack, I want to wrap it up here. I wish you and your family, and certainly everybody who's watching, continue to be safe, continue to wear your mask, continue to keep your distance, do what the experts say we should do. Let's hope those treatments and vaccines come along faster than anyone expected, because that will not only help the stock market and the bond market, it'll help all of us enjoy life more. So Jack, thank you very much again.
Yes, you're welcome.
And
Thanks for inviting me.
Of course, and we'll see you next time. Thank you.
All righty.